This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, let's carry on now and actually do the variance analysis. So exercise 1 in section 3 of the lecture notes. Have a very quick look with me and then we'll get into it. A company has prepared the following standard cost card. So we've got there the standard cost of materials, labour, variable overheads. So appreciate that using marginal costing here. The marginal cost, the variable cost per unit should be 53. We're budgeting on selling them at $75 a unit, and we've got fixed costs of $130,500 for the period. I don't know whether this is a month or a year, it doesn't say. And also we're budgeting on producing 8,700 units. Budgeting on selling 8,000, there's no opening inventory. And so I hope for fairly obvious reasons, we're budgeting on closing inventory of 700. So that's what should be happening, that's our budget. The actual results are below, so we actually produced 8,900 and we actually sold 8,400. And we've got the actual sales revenue, the actual costs for materials, labour, variable and fixed. So they're the actual results. And the overall objective of the exercise is that you'll see we're going to end up producing a statement explaining why the actual profit is different from the budgeted profit. Obviously it will be if we've spent more or less on materials and so on. But we're going to analyse why is the actual profit different from budget. Is it because we've spent too much on materials? Is it because we've spent too much or too little on labour and so on? We're going to do a statement explaining why the two are different. Appreciate, as always, in the exam, you can't be asked a complete full question like this because of the nature of the questions. But any bit of what we do certainly can be asked. So rather than do little bits here, 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 it makes far more sense to do a complete example to make sense of it all. And if you can do the whole thing, then obviously you should have no problem doing little extracts from it. I said earlier how important I think it is that you understand what we're doing. So before we go into the analysis of the variances proper, so to do a little exercise which won't take too long. Won't take long, but bear with me. What I want to do is, first of all, let's write down the original budget. Let's work out how much profit we actually budgeted on. Before I do so, we don't get lost. Remember, in the original budget, we were budgeting on sales of 8,000 units. Whoops. And production of 8,700. So I won't bother writing units because that's just units. However, let's just work down as a result what the profit statement is that we're budgeting on. First of all, the revenue. Each unit should sell at $75. So 8,000 at 75, 600,000. So that's our budget revenue. What about the cost of sales? Well, I'm going to write the statement out in full. So show you the cost of sales. It should be the cost of production less the value of any closing inventory. So the production costs, what do we expect? Well, materials, do check me here please, but we produce 8,700 units. Each unit should cost on materials $18, so we should be spending $156,600 on materials. Labour, Again, 8,700 produced. From the cost card, it should be 25 a unit. So 217,500. Variable overheads. 8,700, $10 a unit, 87,000. And remember, we're using marginal costing for the moment. And so the total marginal cost of the 8,700 produced I get 461, oh dear, 461,100. But that's the cost of the 8,700 produced. To get the cost of the 8,000 sold, we subtract the closing inventory. There were 700 units. Remember, I'm doing the budget here. The marginal cost, 53 a unit. So the closing inventory, 700 at 53, is 37,100, giving a cost of sales of 461,100. A cost of sales of 424,000. So we're budgeting on revenue of 600. We're budgeting on a cost of sales of 424. And so the budgeted contribution, 600 less 424, is 176,000. And finally, the fixed overheads. We were budgeting on, what's it, 130,500? And therefore, we're budgeting on a profit of 45,500. Now, I'm not stupid. I hope not. I could actually have got that figure much quicker, clearly, because the budgeted contribution, I've written up the whole statement. Sorry, I'm trying to change the colour of the pen here. I've written the whole statement down for reasons that I'm coming to, but I could have got that contribution straight off because we were budgeting on selling 8,000. The contribution from each unit, the selling price 75, the marginal cost 53. So we should be getting 22 a unit on 8,000, which is 176,000. But anyway, there were the budgeted figures. But as I said earlier, although that's what we should be spending and that's what we should be earning, our job is to explain why the actual figures are different. However, let's look at one of them. Look at materials, for example. Materials, we actually spent 163,455, but to compare that with the budget is rather silly. You know, I've spent a lot more than we were supposed to, but of course I'm not surprised we spent a lot more because we produced more. We actually produced 8,900 units. Well, obviously if you produce more, you'd expect to spend more anyway. It's a silly comparison. What I really need to know is, are we spending for materials $18 a unit, which is what we should have done, or not? And I spent more, but you know, maybe we are spending the correct amount, $18 a unit. Again, produce more, you're bound to expect to spend more. And so to compare with the original budget is going to be rather stupid. To make sense of it, what we now do, effectively, is rewrite the budget for the actual levels of activity. We'll produce what we call a flexed budget. And we'll say, well, how many did we actually sell? How many did we produce? We actually sold, where are we, 8,400 units? We actually produced 8,900 units. And now let's rewrite the budget. If everything went perfectly, how much revenue should we now expect? What costs would we now expect? And so again, check my figures. But the sales revenue, we actually sold 8,400 units. We should be selling at 75 a unit. So for our level of sales, we should be generating 630,000. What about the cost of those 8,400? Well, again, we'll look at the cost of production less any closing inventory. So we produce 8,900. Materials, we would therefore have expected to spend 8,900. $18 a unit is 160,200. A labour, 8,900 produced, standard cost 25 a unit, 222,500. Variable overheads, 8,900 at 10, 89,000. And so the marginal cost of production, if things had gone perfectly, would be 471,700. The closing inventory, we produced 8,9 and sold 8,4, so the inventory is going to be 500 units. And at the marginal cost, the standard cost of 53, 26,500, giving a cost of sales of 445,200, and therefore a contribution. Revenue 630,000, cost of sales 445,200, a contribution of 184,800. And again, I can check that. Remember, each unit should be giving me $22 contribution. If we sell 8,400 at $22 each, yes, we should now be expecting 184,800. The fixed overheads, they should stay at budget of 135,500 by definition, and therefore on our actual level of activity we're now expecting a profit of 184,800 minus 135,500. That can't be right, sorry, 184,800 minus 130,500, 54,300. And so, with what we call flex the budget, the original budgeted profit was 45,500. Even if everything went perfectly in terms of selling at the right price, paying the right costs, on our actual level of activity, we now are expecting 54,300. And I'm not surprised. I said from the very beginning, if you sell more units, you obviously expect more profit. That the difference, surely. How many more units did we sell? We sold 8,400, we budgeted on 8,000, so we sold 400 extra units. And if you sell 400 more units, you're immediately expecting more contribution. If everything else is perfect, the contribution, 22 a unit, 400 units at $22 is 8,800. And what is the extra profit? 54,300 minus 45,500, 8,800. However, although that's what we should now, the profit we should now have made on our actual level of activity, let's look at how much profit we actually did make. So let's look at the actual results. We actually did sell 8.4 and we did produce 8.9. But let's look at the actual figures. The revenue. So if you look back at the question, the actual results, the sales, the actual revenue was 613,200. We'll analyse what went wrong afterwards, but immediately we've got a problem there. We got more revenue than the original budget, but that's because we sold more. For the number we sold, though, if we'd sold at the right price, we should have got 630. We've only got 613. Pretty obviously, we've been selling at a low price. What about the cost of sales? Materials? We actually spent 163,455. I won't keep repeating myself, but I did say earlier, we spent more than we originally budgeted, but of course we did, because we produced more. However, even taking that into account, we should have spent 160. We spent 163, so in fact we are spending more than we should. Let's finish it though, before I do any more talking. Labour, we actually spent 224,515. Variable overheads, we spent 87,348. So the actual marginal cost of production is 475,318. But that's the actual cost of the 8,900 produced. We want the cost of the 8,400 that was sold. So again, we need to subtract the closing inventory. Standardly though, the closing inventory, we do value still at standard cost. Now I'll tell you why in one moment. But the closing inventory, there are 500 units left. The standard cost was 53 a unit. 500 at 53 is 26,500. Now I'll tell you why we do that. Remember, we're not doing financial accounts. Financial accounts, you value your inventories at actual cost. But the reason we value at standard is that usually this exercise would be done monthly. And you know, some months you might spend more than 53 a unit, some months you might spend less than 53 a unit. Well, we don't keep changing the inventory value every month. Spend more, inventory value at a higher cost, next month value to the lower cost is all going to be a bit silly. So although you can change the standard cost by all means in practice, in our exercises, each month we continue to value inventory at the standard cost of, in this case, 53. On that basis, we get a cost of sales of 475,318 minus 26,500. I hope I'm right here. 448,818. And therefore, our actual contribution, the revenue was 613,200, the cost of sales 448,818, so actual 164,382, and finally the actual fixed overheads 134,074, giving an actual profit of 30,308. Now, I said at the beginning the purpose of this exercise is to ultimately explain, to find out why the actual profit is different than the budget, Why did we only get 30,000 profit when we budgeted on 45,000? Well, we already know one reason. One reason is we sold more units. And if that's all that went wrong, we'd have made a profit of 54,000. So why haven't we made 54,000? Why is it only 30? Well, we can now sensibly compare each of the profit items. Revenue, for instance. Revenue, we should, for our level of activity, we should have got 630,000. We've only got 613,200. And so that has lost us, what's the difference? I should be able to do that in my head. 16,800? Yes, 16,800. As you should be aware, rather than put plus or minus, here it's minus 16,800. Rather than do that, we write against it either F or A. Oops, sorry. There we are. We're down 16,800. Less revenue, that would give less profit. We write against it A for adverse. If it's going to result in less profit, it's adverse. So that's one reason we made less profit. Next one, materials. Materials, we spent more than we should have. How much extra have we spent? £3,255. And again, how's that going to affect profit? If we spend more on materials, we'll end up with less profit. So again, it's adverse. A, adverse, means less profit. What about labour? Well, done badly there as well. We've spent 224,515. We should have spent 222,500. We've overspent by 2,015. So again, adverse. It's going to pull down the profit. Variable overheads. Oh, here we've done well. We expected to spend 89,000. We've only spent 87,348. We've saved 1,652. And of course, if we spent less, that on its own would result in more profit. Well, if there's more profit, we write F against it. Oh, it's happened again. F means favourable. What else? Well, no problem with inventory. I've said we always value that at standard cost, so that's not a problem. The only other thing, of course, is fixed overheads. So we should have spent 130,500. It turns out we spent more. The extra is what? £3,574. And again, we've overspent on its own. That will reduce the profit. And so here's the explanation of why we only got 30,000 when we expected 54,000 from the flex budget. And just as a double check, if I add them up, the variances, there was 16,800 adverse, plus 3,255 adverse, plus 2,015 adverse, minus 1,652 favourable, plus 3,574 adverse. The total comes to 23,992 adverse. And so just as a double check, that should explain the difference between the 54,300 we were expecting and the 33,008 that we actually got. Yes, 23,992. So we now know everything that, all the reasons for the profit being different. We budgeted on 45,500. Most obvious reason for getting a different profit is we sold more units. So that would have led us to expect 54,300. Why didn't we get 54,300? Because we sold at a lower price, we spent more on materials, more on labour, saved a bit on variables, spent more on fixed. Not yet. Later, we will do a little statement just explaining, summarising the reasons for the difference. All right, now all that was fine, and I hope that made sense. And certainly if this is, as it should be, revision, I hope it's not being too boring. But we're not there yet. That was just to try and make sense of what's going on. But where the real work comes is doing some more analysis. You see, materials. Let me use that as a little example. We know we spent too much on materials. We should have spent $18 a unit. So we should have spent, for our production, $160,200. We actually spent $163,455. So clearly, we were spending more than $18 a unit. But why? There are two separate reasons that could have happened. If you look at the cost card, the materials, we should have used 4 kilos of material, and we should have paid $4.50 per kilo. Now, we spent more, but it could have been because we were paying too much a kilo. Maybe we did use 4 kilos of material, but we were actually paying $4.60 a kilo. On the other hand, it could have been that we were paying the right price per kilo, but because we're wasting, perhaps we used too many kilos. Maybe we used 5 kilos of material a unit. And either of the two would have resulted in spending more. Did we use too much materials, or did we pay the wrong price, or a combination of the two? And we need to find out. We need to find out, why did we overspend? Was it the wrong amount of material? Was it the wrong price per kilo? For two reasons. One is we're likely to be measuring the managers on their performance, and it's likely to be 2 separate managers involved. One manager does the purchasing and should be paying $4.50. Maybe the production manager is in charge of the usage of the materials and should be using 4 kilos. So we need to know the 2 managers, have they performed well or badly? And also, it's not simply a question of finding out, oh, we've overspent. We need to know why, to see if in the future we can try and avoid overspending. If we're wasting too much, maybe we can cut down waste in future months, and so on. So the real work is what's coming in the next lecture, where we'll analyse each of those variances to find out precisely why too much on materials, why too much on labour, and so on. So, although I hope that all made sense and is relatively easy, you will not be doing what we've just done. I'm sorry. You'll go straight into this analysis, which is coming in the next lecture. But I've said several times that I think it's vital to be 100% clear about what's happening. It's too dangerous, as you'll see in the next lecture, it's too dangerous to simply learn a rule and not know why. So, pause there, but in the next lecture, we'll go through each of those variances in turn and analyse, find out why they occurred. Okay, but keep that example in front of you. It's the same example we'll be using.